Hello everyone, this is Intelligent Investment Ideas, and in today's video I'd like to talk about our first intelligent investment idea of 2016. And the company I've chosen to spotlight is none other than General Motors. Now the way I'm going to structure this discussion is as follows. I first want to give a quick background on General Motors as a company, what they do as a business, how they make their money, and why I believe the market has misunderstood General Motors, providing a great opportunity for you and me to buy shares of this company at well below its intrinsic value. We're then going to look at the income statements for GM from the last couple of years and see if we can see some trends. See if we can quantify the direction this company is going with regards to its income. We'll then take a look at the balance sheet and see what we can learn from it, and also see if we can spot some trends going on there as well. After that, we're going to look in depth into what's going on in the automobile market generally. This is going to give a more qualitative look and is meant to help us focus on the future of General Motors and what role it will play in this market for years to come. And finally, we're going to conclude this video by summarizing our thesis on why General Motors is currently very undervalued by the public markets and makes for a great investment opportunity. So a quick background on General Motors. Currently headquartered in Detroit, GM was founded in 1908 as General Motors Corporation, and after emerging from a Chapter 11 bankruptcy restructuring in 2009, now goes by the name General Motors Company. GM is an American multinational corporation that designs, manufactures, markets, and distributes automobiles and automobile parts, as well as provides financial services. GM produces vehicles in 37 countries under 13 brand names, with the top 4 marketed in North America being Chevrolet, Cadillac, GMC, and Buick. General Motors currently employs 216,000 people and does business in more than 120 countries. The company is divided into 5 business segments: GM North America, Opel Group, GM International Operations, GM South America, and GM Financial. So the first 4 segments exist to produce and sell automobiles for different geographical markets around the world, and the 5th one, GM Financial, provides customers with financial tools to purchase or lease these automobiles. In a nutshell, that's basically how GM makes its money. GM also makes income from investments in joint ventures with other companies, which we'll highlight later when we're looking at overall market trends and how GM is investing in the future. But when it comes to analyzing GM's financial statements, we're going to focus more on its core business. Now, usually when the market places a deep discount on the valuation of a company for an extended period of time, it's for a reason. For GM, this prolonged pessimism and relatively low valuation is likely due to the events of its reorganization in 2009 and its vehicle recall scandal in 2014. On July 2009, General Motors emerged from government-backed Chapter 11 reorganization, where the new GM bought a majority of the assets of the old GM. Through the Troubled Asset Relief Program, the U.S. Treasury invested $49.5 billion in General Motors and recovered $39 billion when it sold its shares in December 2013, resulting in a loss of about $10 billion. A study by the Center for Automotive Research found that the GM bailout saved approximately 1.2 million jobs and preserved $34.9 billion in tax revenue. So it was viewed in the end as a net win for the government. In the reorganization, Hummer, Pontiac, and Saturn were brands that were closed. Also, renegotiations were made with the United Automobile Workers Union to implement more competitive and sustainable compensation for labor. According to the 2007 GM annual report, typical auto workers earn a base wage of approximately $28 per hour. Following the 2007 national agreement, the base wage was lowered to approximately $15 per hour. Another benefit negotiated by the United Auto Workers Union was the former Jobs Bank program, under which laid-off members once received 95% of their take-home pay and benefits. In 2005, more than 12,000 UAW members were paid this benefit. In 2008, this costly program was suspended to help save U.S. automakers like GM. All the events resulting from this crisis in 2008 and 2009 have only helped to strengthen GM for years to come, but the financial scars that resulted still linger in the minds of investors. Now, if that wasn't enough, on February 6, 2014, General Motors recalled approximately 800,000 of its small cars due to faulty ignition switches, which could shut off the engine during driving and thereby prevent the airbags from inflating. The company continued to recall more of its cars over the next several months, resulting in nearly 30 million cars worldwide recalled and paid compensation for 124 deaths. The fault had been known to certain GM employees for at least a decade prior to the recall being declared. As part of a deferred prosecution agreement, GM agreed to forfeit $900 million to the United States, and the overall cost of this scandal has come in north of $4 billion. That being said, major vehicle recall programs are nothing new to the auto sector. In 2010, Toyota recalled approximately 9 million cars due to the mechanical sticking of the accelerator pedal causing unintended acceleration. This also led to the death of several drivers, and although tragic, the Toyota brand name has recovered and is currently the number one automobile manufacturer in the world, with GM being number 2. I use this example to demonstrate how these unfortunate events have happened before with other companies, and full financial and reputational recovery has followed, which I anticipate to happen with GM brands. Now, here on Intelligent Investment Ideas, I not only present companies that I think make great long-term investments, but I back this conviction up by investing in these ideas with my own money. The positions I take can range anywhere from a few $1,000s to tens of thousands of dollars. Currently, General Motors is by far the largest position in my portfolio, with ownership of 1,500 shares and a market valuation of almost $47,000. As of March 14th, 2016, when I'm making this video. The stock currently pays a dividend of 38 cents per share per quarter, or almost 5% yearly cash returns. My cost basis is a little over $31 per share, which is where it's currently trading at, so if you don't factor in the dividends that were paid out over the last 2 years, I'm essentially breaking even on the investment to date. I started building up a position on GM almost 2 years ago, shortly after the stock price was hit hard by the ignition switch scandal. I put together a spreadsheet that tracks the purchases of GM shares that I made over the last 2 years, and I have not sold anything yet, nor do I intend to in the near future. So now we're going to look into GM's financial report, starting with its income statements. General Motors reports its income results quarterly to the public, and anyone could view these documents on the Investor Relations page of GM's website. If this video inspires you to look deeper into GM and potentially make an investment, I included a link to the Investor Relations page in the description box below. To quickly recap, an income statement is a document provided by the company's accounting department that summarizes the financial performance over a period of time, usually every 3 months. It quantifies how the business incurs its revenues and expenses through both operating and non-operating activities. This basically shows how much money came in and how much went out during that quarter, with the difference being a profit or a loss. In order to keep things standardized, we're going to look at GM's numbers using Generally Accepted Accounting Principles, or GAAP, which is widely viewed as a more conservative lens to view a company's quarterly income with. So this is what GM's income statements look like. We're going to view the data that's been provided over the last 2 years to identify trends that show the direction GM is going as a company. I chose to present only the last 2 years because all the financial data provided is post-recall scandal. This is important because I believe the ignition switch debacle was an inflection point in GM's history that created a challenging 2014 and 2015, but I view that as an opportunity that sets us up nicely for this year and beyond now that most of those issues are in the rearview mirror. Rather than presenting each statement individually, I think the easiest way to view how the company makes its money and how much of its shareholders are entitled to is by structuring GM's income into a flow chart that starts with its revenue sources at the top and then funnels down to the net income that belongs to common stockholders like you and me. We're then going to chart the quarterly results over the last 2 years to determine if there are any trends and then rate each component as having a positive, neutral, or negative trend. I'll be using a simple rating system to identify a trend as being good, very good, bad, very bad, and I'll leave it blank if it's neutral. Let's start off with GM's bread and butter, and that's the revenue generated by automobile sales. As you can see here, there isn't too much of a trend. It's pretty neutral to slightly negative. We started off Q1 2014 at $36 billion, ended that year off at $38 billion, started off 2015 at $34 billion, and ended that year off at almost $38 billion. So to the untrained eye, it would look like there's a slightly negative trend in revenue, but there's other factors playing given the fact that GM sells automobiles all over the world. So we're going to leave that one neutral for now. And I'm going to explain later why it's actually positive if you factor in currency fluctuations. So now we're going to look at the net sales and revenue of the GM's financial arm, and that's obviously a positive trend. It's not going parabolic, but it's definitely going in the right direction linearly. So for the non-operating income, this will be income that's generated from GM's equity and other businesses, partnerships, joint ventures, and everything that isn't their core business. We see a good positive trend. We're not going to focus too much on the non-operating income. That's not what is going to make or break GM in the long run. It's going to be its core operating business, but it's always good to have a positive trend in any income-generating venture. So we're going to rate that good. Now we're going to focus in on the expenses, basically the cost of doing business for GM. Starting with the automotive sector. As you can see here, the expenses for creating automobiles has been declining over the years, and that's a very good thing. In a business like this, you really want to focus in on how much it costs to make each automobile, and you're constantly looking for efficiencies. So it looks like GM has been doing that very effectively, and this is going to get a really good rating. So now we're looking at GM's financials, costs and expenses, and just the nature of the business of financing. The more revenue you generate, the more cost it's going to incur when you're making loans to customers. So this is to be expected. You just want to make sure that your expenses don't go up faster than your the revenue coming in. So, but we don't want this to happen, so we're going to give that a negative rating. For the non-operating expenses, which I have shown here as negative dollars in the millions, we could see that the non-operating expenses are growing as well, so that's also going to be viewed as negative. Now we're going to focus on the net income of each of the revenue sources, starting with the automobile division. As you can see here, the operating income for auto sales is very much positive. It's very much going in the right direction. If you think about it, the revenue is, even if the revenue is stagnating, the fact that the costs have been constantly going down is going to net you a positive income trend. So we're going to get that a very positive rating. So looking at GM Financial's operating income, we do see a decline. It appears that the expenses, the cost of doing business, is accelerating at a rate faster than the revenue generated. So even though it's still profitable every quarter, that profit's declining. So we're going to give that a negative rating. And if we look at the net operating income, by combining the auto sales and GM Financial arm, it's definitely a very positive rating. Mostly because GM Financial, the profits that it generates is not very much in comparison to the auto sales profits. We're talking an order of magnitude difference. So the positive trend in auto sales and profitability is just dwarfing the declining profitability of GM Financial. Looking at the net non-operating income, we're also seeing a positive trend. So we're going to give that a good rating. Now, if you combine all of the net incomes after you factor in expenses of the automotive division, the financial arm, and all of the non-operating income, it's going to coalesce into the total gross income generated for that quarter. And if we look here, we see a very positive trend of gross income quarterly. Normally, I wouldn't focus much on a company's income tax expense, but due to General Motors' bankruptcy and other liabilities, they have a very unique tax situation. In 2010, the Wall Street Journal estimated the tax break, including credits for costs related to pensions and other expenses, can be worth as much as $45 billion over the next 20 years. So here's a chart showing the income tax expenses GM has incurred over the last 2 years. As you can see, for the second half of 2014 and the first half of 2015, the expense was a net negative, whereas the first half of 2014 and the last quarter of 2015, it was a major positive. So consequently, we're going to give the income tax expense a positive rating. But even so, we're going to adjust all income going forward for the income tax expense being so positive. We're going to actually zero out that windfall profit that was made in the fourth quarter of 2015 for earnings going forward. Now here we have a chart of the net income after the tax expense, and as you could see, it's going up exponentially. But a lot of that has to do with the Q4 2015 tax benefit. So we're going to adjust the net income with that Q4 2015 tax benefit zeroed out, and it still shows exponential growth. So we're going to give that a rating of very good for net income. With regards to income generated from non-controlling interest, you see there's not much of a trend. It kind of zigzags back and forth with the positive bias, so we're going to give that a positive rating. Now, with regards to the senior stockholder claims, as you can see, in the beginning of 2014, there was a lot of preferred shares that were senior to the common stockholder. So a lot of that has been retired. So that's actually a very good thing. I didn't bother charting it. I just got the numbers here for you. So that's, obviously when you retire a lot of the preferred shares, that's going to be a very positive rating. So yeah, more income for the common shareholder. Now, for the chart that ultimately we as common stockholders care about is the net income that's left for us that we have rights to. Now, as you can see, that's going up exponentially. Yeah, obviously, the final quarter of 2015 is showing that tax benefit that's kind of goosing profits. So we're going to make an adjustment for that, as I said we would going forward. And we still have a sharply rising net income for the common shareholder. This is exactly what we want to see. A very positive sign for the company going forward. We definitely don't see any kind of topping out of profitability. And we're definitely going to give this one a very good rating. In order to get earnings per share from the net income, all you need to do is divide the net income for the common shareholder by all the common stock shares outstanding, and you get the earnings per share per quarter. And here's the chart for that. Now, of course, this one also shows the tax benefit for the final quarter of 2015, and we're going to make an adjustment to kind of zero that one out, and we still see the exponential growth. Now, it's not going to be exponential indefinitely. It's going to taper off eventually, and it's going to peak, and it's going to decline. But as of now, we're going very much in the right direction, and I don't see this changing at all for at least the next year or two. And another bit of data that also bodes well for earnings per share is the number of shares outstanding is in constant decline due to GM's very robust stock repurchasing program. So it's very simple. You get the net income that GM's getting, which is going up exponentially, as you saw on the charts. You divide it by the number of shares outstanding, and you get the earnings per share. So if you have the number of shares outstanding in a decline, it's going to act as a tailwind for earnings per share for all future quarterly reports. Now, another thing I want to look at is basically all of GM's revenue. I want to lump it all together. So the three sources at the top of this flow chart, the automotive sales, the sales coming from GM Financial, and the non-operating income, I want to lump them all together as just total revenue and do an analysis of that and see where that's going, because ultimately that's where all the money's coming from. That's the start of the income flow chart. So over here at the total net revenues, okay, so how it's reporting, it kind of looks like it's pretty stagnant with a slight positive bias over time. But the thing about that is in 2015, there was a huge currency devaluation going on pretty much around the world, and a strengthening of the dollar bill with relative to those currencies. And I'm going to show you in a few of these charts what's going on. Here's a chart showing the Brazilian real, the value it has versus the dollar over the past 5 years. As you can see, it's been in a steady decline. And here is the Canadian dollar versus the US dollar over the past 5 years. Here's the Chinese yuan. Here's the euro, which just totally went in free fall in 2014. And here's the British pound, which is usually a pretty strong currency, and even that kind of ceded to the dollar over the last couple years. Now, what this means is that when they sell cars overseas, which all of those currencies are markets that GM sells vehicles in, there's a degree of price rigidity to what they sell the vehicles at. And then if that over a year or two, that currency plunges, and then they have to convert all of their earnings to dollars after that currency devaluation, it's going to have a very negative effect on revenue and earnings once they report everything in dollars. So in order to account for that, I adjusted the total net revenues in 2015 for the exchange rate as if there had been no decline in the foreign currencies and no strengthening of the dollar, as if it just held steady. It shows that there was no peaking of revenue and that there was just a steady uptrend in sales. Another thing that I want to take a look at is the dividend per common share that GM is paying out. Now, this doesn't positively or negatively affect the amount of income that GM is making quarterly, but it shows two things. One, it shows how stockholder friendly the management at GM is, and two, it shows a degree of confidence that GM management has in its income going forward. They wouldn't be paying out a generous dividend, and they surely wouldn't be raising it every year if they didn't think that earnings were a safe bet for a long time to come. So as you can see here that GM's dividend has been going up pretty quickly. They raised it by 20% in the beginning of 2015, and they raised it again in the beginning of 2016. And it looks like, they really got room to run. They could bump it up next year to 40 cents a share. And, over the years, it could keep going up, especially when you look at the earnings growth. And then another thing is you look at the total value, the total cost of the dividend payout per common share each quarter. And as you can see, it slowly drifts down, it slowly declines. And then, of course, when they raise that dividend, it's going to spike up. And then it's going to slowly keep on its downward trend. And that has to do, once again, with the declining number of common shares outstanding. So if you have fewer shares outstanding that you have to pay a dividend on, it's going to be less of an absolute cost for you every quarter when you have to pay out that dividend. So that's once again a good thing. It makes the increase in dividend less burdensome on GM's balance sheet because of the constantly declining share count. In summary, the income statements reported by General Motors over the past 2 years show very positive trends that suggest a bright future near term for the automaker. Not only is the total revenue steadily increasing when adjusted for currency fluctuations, the net income for common stockholders is improving rapidly, and the number of shares outstanding is in sharp decline, giving us common shareholders an ever-growing piece of an ever-growing pie. As long as revenue holds up going forward, and we'll address why I think that will happen later on in this video, an increase in earnings per share seems to be inevitable. Historically, the long-term increasing of earnings per share for a company tends to lead to an increase in share market price and dividend payouts. The quarterly income statements of a company shows us how an actively managed business operates to generate revenue and profit. Now we're going to look at GM's balance sheet to determine what the company would be worth if it were no longer an active business and were to be liquidated. In essence, looking at a company's income statement shows us the value of the company when alive, and looking at the balance sheet shows us the value of the company when dead. To determine the value, the balance sheet states the assets, liabilities, and capital of the business at a particular point in time. This too can be found on GM's website in the Investor Relations section and looks like this. There's a simple equation used in accounting to describe a balance sheet, and it goes as follows. Assets equals liabilities plus equity. Now I like to rearrange this with some simple algebra to structure it in a way that best displays what we're looking for as shareholders, and that's equity equals assets minus liabilities. A simple way to understand this is by viewing equity in a company as ownership of a company. If you have 50% equity, you have 50% ownership. In my case, I have approximately 0.0001% or 1/1,000,000th ownership of GM. So assets are items that have a cash value and liabilities are cost and debt. For example, if you're an individual with, say, $60,000 in cash and you own 2 cars, preferably of a GM brand, worth about $20,000 each, then you have $100,000 worth of assets. Then let's say you have $30,000 in student loan debt and about $10,000 in credit card debt. You now have $40,000 total in liabilities. You do the simple math from the equation, and that gives you a net worth or equity valuation of $60,000. Simple enough, right? Now we're going to analyze GM's balance sheet. In the assets column, GM has both current and non-current assets. Current assets are defined as items that could be liquidated to unlock their cash value within 1 year. Non-current assets are items that take longer than 1 year to liquidate for their cash value. Under current assets, GM has cash and cash equivalents, marketable securities, restricted cash plus marketable securities, accounts and notes receivable, GM financial receivables, inventories, equipment on operating leases, deferred income taxes, and other assets. Under non-current assets, GM has restricted cash and marketable securities, GM financial receivables, equity and net assets of affiliates, net property, goodwill and intangible assets, GM financial equipment on operating leases, deferred income taxes, and other assets. For liabilities, GM also has both current and non-current liabilities. Current liabilities being debt and payouts due in less than 1 year, non-current liabilities being debt and payments due more than a year from now. Under current liabilities, GM has accounts payable and short-term debt, and also accrued liabilities. For non-current liabilities, GM has long-term debt, pensions, post-retirement benefits, and other liabilities. When it comes to equity, there are a number of different stakeholders, but the biggest one, and the one we're going to care about, is the common stockholder. So that's what we're going to focus on in this video. Now we're going to try to spot some trends by going over the balance sheets GM's been reporting over the past couple of years. In the asset column, we're going to start by reviewing GM's cash flow, which actually has its own quarterly statement. We're going to look at the cash flow GM generates from different business activities and then track the cash and cash equivalents on GM's balance sheet. First, let's look at the net cash generated by GM's auto sales. As you can see here, the trend is fairly stagnant with a very slight upward bias, but we're going to rate that as fairly neutral. The net cash generated from GM's financial arm is clearly a positive one with a linear trajectory. The net cash from operating activities is also slightly positive. Okay, so the net cash from investing activities, as you can see, is all of it's going to be negative dollars spent, basically. And that also is increasing slightly, even though you saw a sharp decrease in Q4 of 2015. And the net cash from financing activities has been going up pretty strongly. That's a pretty positive trend. And here's just showing the quarterly change in cash and cash equivalents, and you could see a slight downward trend. Now here is just compiling it all together, showing the cash and cash equivalents on GM's balance sheet, and you can see it's definitely going down. So I guess overall we're going to give that a negative rating for the balance sheet, even though you don't want your company to have too much cash on their books, because as investors, as owners, you want to receive some of that cash. So if they have too much cash, they should give it out to the investors through a buyback or a dividend, which is exactly what GM is doing. As you can see here, the current assets in GM's automobile division is trending downward. The current assets of its financial division is going upward linearly. It went from Q1 2014 about 18 billion to the end of 2015 at 24 billion. So that's definitely a steady trend up. If you look at the total current assets, it's trending downward just because the value of assets in its automobile division is way greater than its financial division. It's going to trend downward, so we're going to give that a negative rating. For the non-current assets in its automobile division, as you can see, it's going up quite quickly. It's also doing the same in its GM's financial division. It's going up it looks like it pretty much doubled within the last 2 years. And if you take the total non-current assets, it's moving up in a fast trajectory, possibly in a exponential manner. So we're going to give that a very good rating. So now we look at the total assets. As you can see, it's definitely trending up, and that's mostly has to do with the non-current assets moving up a lot faster than the current assets. As you can see, Q4 2015, GM had assets of about 195 billion, whereas in Q1 2014, it was assets of about 174 billion. So in that time, about $20 billion worth of assets has been accrued. So overall, we're going to give the assets of GM a positive rating for its positive trend. For current liabilities in GM's automotive division, you could see that going down, which for liabilities, you want a downward trend, so that's a good thing. For current liabilities in its financial division, it's going up. Total current liabilities are trending upward, so we're going to give that a negative rating. For the non-current liabilities, you can see that it's hard to tell, but it's a slight upward trend in the automotive division. And you can see a strong upward trend in GM's financial arm. But that's to be expected just due to the nature of the business of lending money. So here we go. Total current, non-current liabilities is definitely a strong upward trend. So we're also going to give that a negative rating. And if you look at the overall liabilities, you can see an upward trend. It's kind of tapering off towards the end, and we're hoping it'll stagnate. You don't want the liabilities to keep piling on, but it's definitely an upward trend. We're going to give that a negative rating. And here we see equity in the automobile division of GM, and that is going down, even though you could see a boost in Q4 2015. It's still a downward trend. And for GM Financial, we definitely have an upward trend for the equity there. So for total equity, we definitely have a slight downward trend with a strong uptick in the final quarter of 2015. As you can see, in 2015, in Q4 2015, it basically $5 billion of equity was added from the previous quarters. That's obviously a good thing, but overall the trend is downward, so we're going to give that a negative rating. So there you have it. From looking at GM's balance sheet, we're looking at a final equity as of Q4 2015, the latest quarterly report, of about $40 billion. And we currently have it trading at a market cap of around $45 billion. So the market is basically giving GM a valuation slightly above its liquidation value. So even though there's some downward trends to the balance sheet, it's not necessarily a bad thing. GM is generously returning capital to its shareholders, so this is going to negatively impact its balance sheet. But the negative impact has nothing to do with reporting losses for its earnings statement. As we looked at all of the income, all of the earnings statements previously, it's nothing but upward trends, nothing but increased earnings. And as we look in the balance sheet, you see quite a few downward trends, something to keep an eye on, which I'll definitely be looking at in the next quarterly report. But nothing I would say that was overly negative. And I still believe that the market cap is a little bit too low given GM's income statements and balance sheets over the past few years. Now that we've reviewed GM's income statements and balance sheets, we have a quantitative view of what the company is worth as both an operating concern and as a liquidated asset. Unfortunately, investing isn't as straightforward as crunching the income and balance sheet numbers and spitting out a fair market cap value. We also have to take a qualitative view of GM and determine what role it plays in its market, what the future prospects are for the company in its market, and what the future prospects are for that market. We have to make educated guesses about how GM will evolve in an ever-changing, competitive market, and how it will grow for years to come. Before we start analyzing the market for automobile manufacturers, I'd like to do something called whale watching. And that activity entails seeing what top hedge funds are doing with a particular stock. As you can see here with GM stock, the top shareholders are Berkshire Hathaway, ran by Warren Buffett, Greenlight Capital, ran by David Einhorn, and Appaloosa Management, ran by David Tepper. It appears that over time they have been increasing their stake whenever the stock price has gone down, which is clearly a vote of confidence in the company, because you wouldn't buy more of something if you're pessimistic about its future. Although you should never buy or sell something because a hedge fund manager did, just look at the disaster that's currently taking place with Bill Ackman's huge position in Valiant and even Herbalife. You can use this information as a tool to look deeper into a given stock if you notice any unusual activity coming from these hedge fund whales. As of now, it would appear that we're in good company as GM shareholders. Now, looking at the auto market, there are a few key statistics I want to review that could possibly give us insight into the future of demand for automobiles. For one, the average age of an automobile in the United States has steadily increased over the past 20 years. If you look closely, you can see that during recessionary years, the age ticks up due to people holding off on a new vehicle purchase. Then it resumes its previous trajectory. Although some of this increase in age is due to an increase in quality and longevity that vehicles are built with to have nowadays, the fact that the average age of a vehicle on the road is at an all-time high can't help but serve as a tailwind for auto sales. When it comes to auto sales, it's also good to know how deeply GM has penetrated a given market and if there's any saturation taking place or if there's room to increase market share. Currently in the U.S., General Motors has a market share a little over 17%. So, it's pretty high, but it can go higher. I could see that going to 20% if management runs things correctly. In Europe, we have a little over 6% market share, and that could obviously go up. In Asia, the Middle East, and Africa, we got a little over 10%, and there's obviously more room that could be ahead there. And for South America, we have a 16% market share. But currently South America, and for the foreseeable future, probably isn't going to be the best market. So, getting more market share may be a good, maybe a bad thing. We'll see. So if we want to look deeper into the numbers and see if we can spot any trends, we're currently looking at a worldwide market share that hovers between 11 and 11.5%. As you can see in the United States, which is where most of it's coming from, GM is definitely increasing its share from about 20% to 25% over the last 2 years in the U.S. truck and SUV market, which is a really big, really good high margin market. So that's a very good thing. It's losing market share in the U.S. car market. It's gaining market share in the international operations, which is basically China. It's losing market share in Europe, but that's a market where they've been getting losses, so that's not necessarily a bad thing. But just worldwide, generally, GM has been slowly increasing its market share. Looking at the hard vehicle sales number by volume, we're going to split things up between retail and wholesale vehicles, due to the fact that these are different markets and should be viewed as such. There's a lot of good data here in this table, so now would probably be a good time to pause the video and look at the numbers that interest you. I just want to show that there has been a steady, uninterrupted upward trend of vehicle sales by volume worldwide when it comes to both retail and wholesale vehicle sales. The reason I say this is because in the media there's been a general narrative saying that there's been a topping off in vehicle sales that occurred in 2014 or 2015, and the numbers say that is just absolutely not true. For quite a while, I have been looking over publicly available national statistics that have had a dependable correlation with vehicle sales. I looked into the relationship between gas prices and vehicle sales, household income and vehicle sales, GDP growth in vehicle sales, and I was only able to find one that I felt had a strong enough correlation that would allow me to comfortably draw conclusions from, and that statistic was the national unemployment rate. This statistic really tells you something. That it essentially says that when Americans have jobs, they buy cars. It's that simple. This is true for a number of logical reasons. One, if you have a job, you're likely to need reliable transportation in order to get to that job. Two, if you have a job, you're likely to have income and the credit necessary to buy a car. And three, Americans simply have an emotional attachment to their vehicle, and purchasing a new and better car is for a lot of people a way of showing that they have arrived. I think the last point is pretty fucking stupid, but I'm not here to judge, I'm here to invest. Now, at first glance, it isn't easy to see a visible correlation between auto sales and the unemployment rate. But once you put it into a spreadsheet like so, the relationship becomes pretty undeniable. So what we're looking at here is an obvious negative correlation between the monthly unemployment rate and the monthly auto sales rate. This graph displays the inverse correlation that has held true for the past 40 years. The y-axis doubles as the automobile sales rate in millions and the unemployment rate in percent. And the x-axis shows each month over the last 40 years. Now, a negative or inverse correlation means that when one variable goes up, the other one goes down, and vice versa. We can even quantify mathematically the strength of the inverse correlation in Excel with an average correlation coefficient of negative 0.725. For some context, -1 means a perfect inverse correlation, and 0 means no correlation at all. Keep in mind that there's a lot of noise in the auto sales number, so as I were to cancel this out and just track the overall trend lines, I wouldn't be surprised if the correlation increased to -0.8 or even a -0.9. As of March 2016, we are currently at an unemployment rate of 4.9%. Given the 40 years of historical data shown here, we can make two sensible predictions. One, an unemployment rate below 5% serves as a very conducive environment for auto sales. And two, it would appear that in the past, when unemployment dipped below 5%, a virtuous supply and demand cycle ensued for about a year or two, before too much credit in the system caused a recession. That being said, we just recently dipped below 5% unemployment, which means that another year or two of strong auto sales in the U.S. is very possible. Now that we've taken a closer look at current and past market conditions, it's time to talk about the future and changes that are taking place at GM and in the industry. In late 2014, GM outlined its strategic plan for growing sales and profitability into the future. This plan consisted of leading the industry in product and technology, growing Cadillac, growing in China, growing GM Financial, and delivering core operating efficiencies. Now, in order to keep this video to the point, I'm not going to go in depth at each one of these initiatives, but I will say that so far GM has been executing well on each of these goals, and we were able to quantify the operating efficiencies earlier by charting the downward trends in operational expenses. Over the last couple years, GM has also been making major investments in the future. The top 3 areas GM has been investing in are 1. Car sharing services, 2. Autonomous vehicles, and 3. Vehicle connectivity. In January of this year, GM made a $500 million investment in Lyft, the car sharing service who is the main competitor to Uber. The partnership will make GM rental vehicles available to Lyft drivers in select cities. Now, I'm not going to go too deeply into how Lyft operates as a company, but what we need to know is that Lyft is growing exponentially. It's a major player in an industry that is currently growing and will continue to grow exponentially. And with a valuation of $5 billion, GM got in on Lyft while it was still reasonably priced. The partnership also has a great potential for massive synergy that can open up new streams of revenue for GM going forward. In the same month, GM also launched Maven, a car-sharing program similar to Zipcar, where customers use its application to search for and reserve a vehicle by location or car type to drive on a short-term basis. Through the Maven application, remote functions such as starting, heating or cooling, and generally operating the vehicle are enabled. As recently as 1 week ago, GM purchased Cruise Automation, a San Francisco-based developer of autonomous vehicle technology, for $1 billion in order to use their technology and employees to launch autonomous vehicles that will work in conjunction with its ride-sharing services. The details are yet to be known by the public, but this acquisition shows that GM is extremely serious about being at the forefront of autonomous car driving technology. GM is also leading the industry in connected vehicles and plans to invest further. According to GM's executive director, GM sold more 4G LTE connected vehicles in 3 days of June 2015 than the rest of the industry did in the first half of the year. High-speed connectivity will enable dozens of new revenue-generating applications. This includes everything from maintenance adjustments and emergency response to navigation help and passenger entertainment. GM CEO Mary Barra forecasts these services as having a $350 million impact through 2018. Although the bigger value lies in the ties that the car maker can forge with its owners, drivers, and passengers. With all the future changes in the industry, there's been a lot of hoopla about competition from the giants in Silicon Valley. Rumors have been floating around that Apple and Google may be getting into the automobile space, which obviously won't bode well for GM and any of the automakers. I personally think this concern is overblown. The automobile manufacturing industry is not an easy market to penetrate. It's very capital intensive, highly regulated, and riddled with risks. The only 2 tech companies that even have a prayer at competing with any of the established automakers are Apple and Google. Now, currently, Apple technology can be found in vehicles with CarPlay, and so can Google's with Android Auto. Although both companies are keeping quiet about any auto manufacturing ambitions, it is well known that they are both developing self-driving and different vehicle technologies. If any vehicle models are to be launched by either company, it probably wouldn't be available to the public until 2020 or possibly much later, and it would likely cater to a smaller, high-end, niche market and directly compete with the likes of Tesla as opposed to mass producers like GM, Ford, and Chrysler. So let's recap. In this video, we've analyzed the income statements and balance sheets reported by GM over the last 2 years. We looked at GM's role in the overall automobile market, past and present, and we did our best to see what the future might have in store. In order to keep this video under an hour long, I didn't get too granular with the line item data in GM's financial statements, but chose to focus more on general trends. For GM's income statement, we structure the company's income as a flow chart that starts with the revenue generated by selling automobiles, providing financial services to customers that want to purchase automobiles, and other non-operational income, and ends with the earnings per share of common stock. The positive trend in the earnings per share is undeniable, yet the stock currently trades at a price that's roughly 5 times last year's earnings. And with a projected earnings per share of $5.50 for this year, which I think is a low estimate, and I expect closer to $6 of earnings per share for this year, we're still looking at a price to earnings multiple of between 5 and 6. These are extremely low multiples historically for the company. These multiples are only warranted if there is to be a major decline in the near future, which according to the data, I see no signs of. The market can only keep these levels of unwarranted pessimism for so long without proof of an actual decline in GM's business. Even short term, I think that if GM reports earnings for Q1 2016 that shows strong sales, as it has done for the past several quarters, the sentiment towards the company can't help but turn positive and result in a higher stock price. When we looked at the balance sheet, we also saw strength. Although I will be keeping a close eye on GM's book value going forward, the company's market cap is currently trading at approximately 1.2 times its book value. I believe that with the increased operational efficiency that are reflected in GM's declining cost and expanding profit margins, the downside risk is limited. The issues that brought GM down in 2008 were its burdensome union labor cost, generous pension payouts, and an inefficient operational structure that resulted in small margins and a greater risk of heavy losses during recessionary years. All these issues have been greatly improved since GM's restructuring. Even with the company's very generous dividend payout to shareholders and robust stock repurchasing program, I believe that the increase in absolute earnings will not only protect but improve GM's balance sheet. Based on the company's earnings forecast and balance sheet, the stock looks cheap. When you look at GM with a more qualitative lens, we saw that several strategic investments have been made over the last few years and even the last few weeks that position GM to not only keep up with the changes that are taking place in the auto industry, but lead the industry when it comes to vehicle connectivity, car sharing, and autonomous driving technology. I believe that GM is the mass production automaker who is best positioned for the future. In conclusion, I highly recommend those who are looking to make a long-term investment in the common stock of a company to use this video as a tool and take a deeper look into General Motors. Well, I hope that was informative to you all, and until next time, happy investing and cheers.